Most people think financial crises announce themselves with panic. They imagine red screens, breaking news banners, people running for exits. That's almost never how it starts. It starts with contradictions. It starts with markets doing things they are not supposed to do at the same time. It starts when signals that used to cancel each other out suddenly move in the same direction. That is exactly what we are seeing now. Equities are rising aggressively. Precious metals are rising aggressively. Real assets across the board are being bid higher at once. In a stable system, that does not happen. Risk and safety do not rally together unless something deeper is wrong. When everything rises together, it doesn't mean everything is healthy. It means the unit measuring value is failing. What you are witnessing is not growth, it is repricing. The economy did not suddenly become more productive overnight. Companies did not discover new efficiencies in the last week. Workers did not get meaningfully richer. What changed is the value of money itself. The denominator is shrinking, and when the denominator shrinks, every asset priced in it appears to rise. This is how monetary stress disguises itself as prosperity. On paper, portfolios look larger. On paper, indexes make new highs. On paper, everything feels fine. But paper is exactly the problem. When money loses credibility, people don't stop spending. They accelerate it. They don't hold cash, they convert it. Not because they want more assets, but because they want less exposure to currency risk. That behavior pushes prices higher across the board. Stocks, metals, property, collectibles, everything becomes a temporary shelter. This phase has been studied before. It appears late in the life cycle of monetary systems. It is not optimism. It is fear expressed through buying. The danger is that it feels good at first. People see account balances rising and assume they are winning. They confuse nominal gains with real gains. But if the currency is weakening faster than assets are rising, the illusion collapses quickly. Gold exposes this illusion better than anything else. Gold does not care about earnings. It does not respond to productivity. It responds to confidence in money. When gold rises aggressively at the same time as equities, it is telling you something critical. It is telling you that investors no longer trust the currency to preserve value on its own. Silver takes that message further because silver is not just monetary. It is functional. It is consumed. It is embedded in the physical economy. When silver moves sharply higher during monetary stress, it signals something more serious than portfolio hedging. It signals pressure inside supply chains. Supply chain pressure does not stay abstract. The first phase is price. The second phase is availability. We are now entering the second phase. Quoted prices suggest abundance. Real-world access suggests scarcity. That gap is widening. Manufacturers who rely on silver are not looking at charts. They are looking at inventories. They are not debating whether the price is high. They are asking whether supply will arrive at all. When inputs stop arriving, production stops. When production stops, economic narratives break. This is where the system becomes unstable. Because financial markets are built on expectations of continuity. Continuity of settlement, continuity of delivery, continuity of liquidity. When continuity is questioned, behavior changes immediately. Participants stop trusting intermediaries, they shorten supply chains, they bypass markets, they secure resources directly. This behavior drains visible inventories and stresses the hidden plumbing of the system. That plumbing is already under pressure. Intermediaries are facing a liquidity mismatch. Rising prices increase the capital required to operate. Inventory becomes expensive to finance. Credit tightens at the worst possible moment. When intermediaries cannot finance inventory, they reduce activity. They widen spreads. They limit bids. They refuse to quote. To outsiders, this looks like demand disappearing. In reality, it is demand overwhelming the system's ability to intermediate it. That distinction matters. Illiquidity is not the absence of value. It is the absence of flexibility. Flexibility disappears before collapse. This is why the experience on the ground feels strange. People see rising prices but encounter resistance when trying to transact. They expect enthusiasm and meet hesitation. That hesitation is not doubt. It is constraint. Dealers are not bearish, they are capital starved. This is what happens when price moves faster than liquidity. Cash cannot keep up. Risk cannot be hedged efficiently. Market makers protect themselves. Protection creates fragmentation. Fragmentation means different prices for different participants, different access, different rules. Fragmented markets are unstable by definition. The longer fragmentation persists, the more likely a reset becomes. Resets are not gradual. They occur when stress exceeds tolerance at a critical node. That node could be an exchange, a clearinghouse, a major intermediary, or a policy decision. You will not know which one until after the fact. What you can know is the direction of pressure. Pressure is building where claims exceed resources. Silver is one of the clearest examples of that imbalance. Demand is not speculative alone, it is structural. Supply is constrained. Production cannot respond quickly. Inventory buffers are thin. Those conditions do not resolve quietly. They resolve through repricing or rationing. Either way, the experience is disruptive. This is why the current environment rewards understanding structure rather than chasing momentum. Momentum is visible. Structure is not. Structure is revealed through behavior. Who is willing to wait? Who is willing to pay premiums? Who is changing rules instead of expanding supply? Those signals are already present. This is not a prediction of catastrophe. It is an observation of stress. Stress does not mean immediate failure. It means sensitivity. Sensitive systems respond sharply to shocks. The shock does not need to be large. It only needs to occur. That is what makes this moment dangerous. Not panic, but fragility. Fragility exists when small disturbances produce large outcomes. We are closer to that point than most people realize. And that is why attention matters now, before clarity arrives at a cost. Once fragility enters a system, behavior changes faster than headlines. Institutions stop optimizing for returns and start optimizing for survival. That shift is subtle at first, but it compounds quickly. You can see it in how contracts are written, how inventories are managed, how counterparties are chosen. Trust narrows, optionality shrinks. This is why liquidity is the first casualty of monetary stress. Liquidity is not money. Liquidity is willingness. Willingness to transact, to make markets, to take the other side of a trade. When confidence erodes, willingness evaporates even if money technically exists. This is the environment forming now. Prices rising together across asset classes is not coordination. It is avoidance. Everyone is avoiding the same thing, holding currency risk. That avoidance pushes capital into anything perceived as scarce or durable. It overwhelms systems designed for orderly flow. Silver sits at a unique intersection of that flow. It is small enough to move violently, necessary enough to matter, and financialized enough to reveal stress early. As stress builds, behavior diverges between participants who need silver and those who trade it. Industrial buyers do not wait for pullbacks. They secure supply. Traders debate charts. That difference creates pressure. Pressure reveals weak links. The weakest link right now is intermediation. The modern market assumes that intermediaries can always absorb volume, always provide bids, always finance inventory. That assumption only holds when credit is cheap and predictable. Neither condition applies anymore. Financing costs are rising, credit conditions are tightening unevenly, risk is being repriced in real time. Intermediaries feel this first because they operate on thin margins with high velocity. When volatility increases, those margins disappear. This is why you see widening spreads and selective participation. It is not manipulation in the simplistic sense. It is self-preservation. Self-preservation fragments markets. Fragmentation means that quoted prices lose meaning. They become references rather than realities. This is when confusion peaks for the public. People see a number on a screen and assume it represents an executable price. They assume liquidity exists because price exists. That assumption breaks down during transitions. In transitional periods, price and access decouple. Access becomes more valuable than price. This is a difficult concept because it contradicts decades of financial conditioning. We are taught that price is everything, that markets clear continuously, that liquidity is infinite. Those assumptions are conveniences, not laws. They hold until they don't. When they don't, the market becomes binary. You either have access or you don't. You either have the asset or a claim on it. Claims behave differently under stress. Claims depend on counterparties, settlement systems, and rule enforcement. Assets depend on possession. This difference matters more as trust erodes. Trust erodes quietly at first. It erodes when delivery times lengthen, when exceptions become normal, when rules change without warning, when assurances are repeated too often. Each of those signals is present now. This does not mean collapse is imminent. It means the margin for error is shrinking. Shrinking margins make outcomes more sensitive. That sensitivity is why volatility increases. Volatility is not chaos. It is information. It tells you where stress is concentrated. Right now, stress is concentrated in assets that expose currency weakness and supply rigidity simultaneously. Silver does both. That is why reactions to silver feel exaggerated. It is not the metal misbehaving. It is the system reacting to exposure. Exposure is uncomfortable. Exposure forces choices. Choices reveal priorities. Priorities are changing. We are seeing a shift away from efficiency toward redundancy, away from leverage toward ownership, away from promises toward possession. These shifts do not reverse easily because they are rational responses to uncertainty. Once participants experience restricted access, they do not forget it. Once they experience rule changes midstream, they do not assume stability again. Memory is sticky in markets. The memory of scarcity alters future behavior long after conditions normalize. This is why post-crisis markets never return to their previous state. The architecture changes. We are in the early stages of such a change. The challenge is that early stages feel contradictory. They feel wrong, they feel temporary. Most people assume reversion. Reversion is comfortable. Transition is not. But transitions do not announce themselves clearly. They reveal themselves through inconsistencies. Stocks rising alongside metals is an inconsistency. Rising prices alongside tightening liquidity is another. Strong demand alongside hesitant intermediaries is another. These are not coincidences. They are signals. Signals do not tell you what will happen. They tell you where pressure is building. Pressure seeks release. Release can take many forms: repricing, rationing, regulation, restructuring. You do not need to predict which one occurs to prepare. Preparation is not prediction. Preparation is reducing exposure to forced outcomes. Forced outcomes occur when you rely on liquidity that disappears, rules that change, or access that is revoked. Avoiding forced outcomes requires flexibility. Flexibility comes from simplicity. Assets you control are simpler than claims you cannot. This does not mean abandoning systems entirely. It means recognizing where systems are fragile. Fragility is not evenly distributed. Some assets amplify fragility, others absorb it. Silver absorbs monetary fragility and exposes logistical fragility. That dual role makes it volatile and misunderstood. Misunderstood assets are often mispriced. Mispricing does not correct smoothly when supply is tight. It corrects abruptly. Abrupt corrections feel unfair to those unprepared. Prepared participants experience them as confirmation. The difference is timing, not intelligence. Timing is shaped by awareness. Awareness comes from watching behavior, not narratives. Narratives lag behavior. By the time narratives align, positioning is already crowded. We are not at that stage yet. There is still skepticism, still confusion, still disbelief. That tells you this process is not complete. Completion comes with consensus. Consensus is not present, which means volatility remains asymmetric. Asymmetry favors patience over precision. Trying to time exact moves in an environment like this increases risk. Understanding direction reduces it. Direction is toward reduced trust in currency and increased demand for scarce necessary assets. That direction is supported by incentives. Incentives do not lie. They shape behavior regardless of rhetoric. Right now, incentives reward securing access and penalize reliance on frictionless liquidity. That incentive structure will not change until stability returns. Stability returns only after stress resolves. Stress has not resolved. It has only begun to surface. As stress continues to surface, the most important mistake people make is assuming they will receive a warning before conditions change materially. Markets rarely provide clean alerts. They provide friction. They provide delays. They provide contradictions. Those are the warnings. When people say they were blindsided, what they usually mean is that they ignored early discomfort because it didn't fit the narrative they wanted to believe. Right now, discomfort is everywhere if you know where to look. It shows up in how transactions slow even as prices rise. It shows up in how institutions quietly change behavior without announcing it. It shows up in how confidence is expressed loudly while caution is practiced privately. This divergence between words and actions is always present before major shifts. Public optimism is cheap. Private positioning is honest. Private positioning right now favors durability over speed, ownership over leverage, access over yield. These preferences are not ideological. They are adaptive. When systems feel reliable, efficiency wins. When systems feel fragile, redundancy wins. We are watching that shift unfold in real time. This is why the current moment feels confusing to many observers. Old rules are still referenced, but new rules are already being applied. Markets have not stopped functioning. They have started functioning differently. The participants who recognize that difference early are not louder. They are quieter. They move capital without announcing it. They secure positions rather than debate narratives. Debate belongs to stable periods. Preparation belongs to unstable ones. The irony is that instability does not always feel dramatic at first. It feels inconvenient. It feels inefficient. It feels annoying. Orders take longer. Quotes are less firm. Spreads widen. Exceptions become normal. These are not glitches. They are adaptations. Adaptations occur when systems are stressed but not yet broken. This is the most dangerous phase because it creates false confidence. Things still work, just poorly enough to be dismissed. That dismissal delays adjustment. Delay increases cost. Cost appears suddenly when adjustment becomes mandatory instead of optional. That is when people realize optionality has vanished. Optionality is the ability to choose timing. Once timing is chosen for you, outcomes worsen. This is why the goal now is not maximizing returns, but minimizing dependency. Dependency on continuous liquidity, dependency on stable rules, dependency on intermediaries behaving normally. Reducing dependency increases resilience. Resilience does not require perfection. It requires margin. Margin is created through simplicity. Simple structures break less often. Assets with fewer moving parts behave more predictably under stress. Silver's behavior looks chaotic on charts, because charts reflect financialized trading. Its role in the real economy is far simpler. It is used, it is consumed, it is required. Those facts anchor value even when markets fragment. This is why volatility around silver often increases precisely when its importance increases. Volatility is not a sign of irrelevance. It is a sign of contention. Contested assets reveal fault lines. Fault lines widen before earthquakes. You do not need to predict the earthquake to step away from the fault. That is the mindset required now. Stepping away from fault lines does not mean abandoning markets or retreating into fear. It means recognizing where fragility concentrates. Fragility concentrates where leverage meets necessity, where promises exceed inventory, where speed replaces verification. Those conditions are present now. The temptation is to overanalyze, to wait for perfect clarity, to demand confirmation. That instinct is understandable but costly. Perfect clarity arrives only after repricing. By then, positioning is expensive. This is why history often seems obvious in retrospect. Outcomes feel inevitable once resolved, but inevitability is only visible after preparation opportunities close. Right now, opportunities still exist because disbelief still exists. Disbelief keeps participation uneven. Uneven participation prevents consensus. Without consensus, trends extend. This is not about cheerleading any asset. It is about recognizing process. The process unfolding now is one of reassessment. Reassessment of currency reliability. Reassessment of supply assumptions. Reassessment of financial architecture. Reassessments are disruptive because they force reprioritization. What was once secondary becomes primary. Access becomes more important than yield. Certainty becomes more important than optimization. Durability becomes more important than efficiency. Those priorities reshape markets. They also reshape personal decision-making. This is why emotional discipline matters now. Emotions are amplified when systems feel unstable. Fear and greed oscillate rapidly. Rapid oscillation leads to poor timing. Poor timing leads to forced outcomes. Forced outcomes transfer value from the reactive to the prepared. That transfer is not malicious. It is mechanical. Markets reward preparation because preparation reduces forced behavior. Nothing about this requires panic. Panic belongs to those caught by surprise. Surprise happens when warning signs are ignored. The signs are visible now, not as headlines but as friction. Friction in settlement, friction in delivery, friction in liquidity. Those frictions are telling you the system is adjusting. Adjustment is not collapse, but adjustment is not comfortable. Comfort returns only after repricing aligns incentives again. That alignment may take time. During that time, volatility remains elevated, narratives conflict, and confidence is tested. Confidence should not be confused with stubbornness. Confidence comes from understanding structure, not predicting outcomes. Understanding structure allows patience. Patience allows resilience. Resilience preserves optionality. Optionality creates opportunity. This chain is why preparation matters long before events become obvious. It is also why shouting predictions is less useful than quietly aligning exposure. You do not need certainty to act intelligently. You need awareness.